Hey, welcome to the 40 Finance channel, everybody. My name's Jeff Beers. I've got 3 dead money stocks, at least in terms of a few authors I found online here recently. So we're going to go through the list and look at the fundamentals and the analyst projections, and I'll give you my thoughts on whether or not they are actually dead money. All right, for each of these, I'm just going to share the article that I read, the sort of dead money quote from, and try to go through a couple points from each author, let you make your own decisions. Then we'll jump into the fundamentals of each stock using Stock Rover to kind of project, how true is this? How concerned should holders be about these strong statements that some authors have made? So the first one here is Apple. This is a Seeking Alpha author. And just to be clear on Seeking Alpha, just about anybody can publish an article on here. However, this one kind of passed some of the sniff tests because it had so many comments and likes. So at worst case scenario, a lot of people put eyeballs on this. And it's got a nice little bullet point summary here. Apparently, the author enjoys using Apple products. However, the company's core product line, the iPhone, has saturated the U.S. market and faces increasing competition abroad. Apple produced significant growth in 2021, but future growth in future years will likely be very minimal. Apple currently trades at a PE ratio on par with growth companies, but should face increasing pressure as the company enters a slower growth environment. Apple stock likely has very limited upside from here and could be dead money investment for now. And then he pitches some service that he's selling. We could spend a whole video just probably on this article, and I want to hit other so-called dead money stocks. So let's jump over here to Stock Rover. This is a new tool that I've been using, and this is starting to become my replacement for Yahoo Finance. Very affordable. There is a free trial link in the description, an affiliate link for me. I do get a couple bucks if you sign up, but it's 14 days, no credit card, no nothing. And look for the Premium Plus plan if they ask which trial you want to do. Now, in regards to Apple, I want to look at a couple things for all 5 stocks I'm going to feature today. That is their projected growth and where their valuation sits compared to some historical norms that the stocks have had. Each of the 5 stocks are large cap stocks, so we have a decent chunk of history, and I'm just going to scroll down. For reference, Stock Rover does its own fair value rating. I'm not 100% sure how closely it compares to the Morningstar ones that I've been using previously on the videos. However, they have a fair value of 143 for Apple, and they do this margin of safety, which is very close to like the star system that Morningstar uses. So what it's basically saying is, you could have a minus 5% drop off of today's price of, what was that again, 151. They see some potential for 5% downside as it relates to fair value. All right, now let's go down to valuation. And as you guys know, I am a big fan of valuation history, particularly for large cap stocks. And that's one of the things that works out pretty well here with Stock Rover. They offer a 5-year PE range, price to book, price to sales. And when we look at just this chart for Apple, you can see that it's not quite at the highest point that it's been at 43 times. But it is leaning to the upper percentile. And then price to book, I'm not sure why this is so high right now. And price to book is a tough one because there's a lot of different metrics involved. But for the record, it is trading at the high range of price to book over the past 5 years. And then price to sales, currently at 7. The range is 2.7 to 9.1. However, I would agree, even with this range here not being at the top, that Apple, 7x sales for a consumer product company is probably a little high. All right, now let's take a look at what analysts are thinking for Apple. Currently, they have a strong buy rating across 21 analysts, but the information I'm looking for is down here, and let me see if I can squeeze this in. All right, I think that adjustment will be better. Okay, so earning estimates details. Average EPS estimate for the current year, which is 2022, you've got 571. Next year at 610 is the consensus average. All right, on the revenue estimate side, 381 billion. That would be 4.3% growth in the current year. Next year, jumping another 5.5% to $402 billion. Now let's look at the EPS trend. Current year, 571. And we look through the trend in terms of which way is it going. And it's actually risen 2.3% from 90 days ago. And the 2023 estimate is actually risen 3.7% from 90 days ago. All right, so you've got about roughly 5% growth in this fiscal year, 2022, and next fiscal year, 2023. And that's where things stand today, with the trend going up ever so slightly, about 2% or so. Then we go back to our valuation history, and this is a cool graph. It's called the football field in Stock Rover world, but it shows where is Apple's valuation across several metrics over the past 5 years. And you can see from a PE standpoint, we're looking decent, right in the middle, arguably fairly valued. Then EV to EBITDA sits right about in the middle. There's a couple, though, that are higher than average. Price to book, we talked about, price to sales, cash flow, free cash flow, all running a little bit hotter. Dividend yield and price, those naturally go up over time with a stock like Apple. So what I would say by looking at this is not necessarily that Apple is dead money at the current price of about $150 or so. I think that you do have some growth. I think if you're starting a new position, you obviously want to lop off 5 to 10% if you ever see that opportunity. But I'll tell you from experience that the biggest thing that Apple does from a stock perspective is just surprise consumers, okay, and surprise analysts. And I'm not talking about surprises in terms of earnings surprises and profit surprises. They launch new products that time and time again I've thought, those are probably not going to do that much, and they've went on to explode. So with Apple, while they're calling it dead money, or one author was calling it dead money, over the next year or so, I think that if you get the opportunity to get this one a little bit lower, maybe under that fair value number of 143, if you can hold it for 3 to 5 years, like you really should hold any long-term stock, somewhere in that 3 to 5 year period, Apple is going to surprise with a product that we didn't see coming. And if it does well, you have the opportunity to make a lot of money. All right, next up we have an author that says Amazon stock is now dead money. Amazon reported disastrous third quarter results. Luckily, Amazon Web Services was able to save the day. Slowing growth and rising costs, Amazon stock is now dead money. And just like the other author, he goes on to share details about that. But let's take a look at Stock Rover. And let's start this time with the football field. Let's get a feel for our valuation as it stands today. And we see from a PE perspective, an EV/EBITDA, price to book, price to sales, price to cash flow, and then, price is always running higher. Right off the bat, in terms of trailing metrics, you have Amazon sitting fairly squarely in the undervalued realm. All right, so valuation looks pretty fair at the bare minimum. You got the Stock Rover fair value of $4,108. It's a margin of safety of 19% from today's price. Now let's check out our growth. And for this, I'm just going to go straight to the analyst tab. There you see there's a lot of strong buys in for Amazon. Let's take a look at our EPS estimates. Get them squared up here. Current year, $44 for EPS. Next year, $54.85. Revenue, this year, $472 billion. Sales growth of 22%. Next year, 2022, $556 billion, growth rate of 17%. Now, one thing that is interesting about Amazon is we look at our EPS estimate trends over here, and the current year is taking a hit from analysts, down 20%. This 44.11 is down 20% from where it was 90 days ago. Next year, that's trending down too, minus 24%. So there's definitely an argument here that the outlook for Amazon is cooling off a little bit, and that all comes on the heels of their earnings report with the increased cost and things like that. But from a growth standpoint, and frankly from a core EPS standpoint, I still see some value here. Now, to be clear for me, I am an Amazon stockholder. I just have 3 shares. I bought in just slightly under $3,200 this year. And I've said it on the channel before, I think this is a $4,000 stock. Now that $4,000 I called out a few months ago, the EPS estimates have come down. So that $4,000 could take into next year, whereas I thought it had the potential to hit perhaps as soon as the end of January when they release their earnings call. But I definitely am not thinking of Amazon as a dead money stock, and I think that there's a lot of growth in these numbers that support that. The kicker is going to be the EPS. Dragging that down really hurts the fundamentals. I don't mind because I'm in this one 3 to 5 years easy, and I certainly don't think dead money is the right description for Amazon. All right, next on the board is AT&T, and this is just a headline from Barron's from October 8th, and I don't have a Barron's subscription, so we can't read it, unfortunately. But what it's saying is AT&T has been dead money. So I would argue that AT&T is probably dead money, in my opinion, minus the outstanding dividend. But I thought that this was a funny spin because now it's saying it may have finally fallen enough. So let's take a look at the numbers and see what we see. All right, we'll start with the football field. Well, I'm not exactly sure why the PE doesn't show up here. EV/EBITDA looks pretty high, but the rest of the metrics in terms of price to book, price to sales, cash flow metrics are all seemingly at all-time lows, certainly over the past 5 years anyway. So that looks promising from a valuation standpoint. Now let's take a look at what analysts are projecting for AT&T and see if we've got maybe a change in the forecast. Look at average EPS estimate current year, $3.35. All right. Next year, which is fiscal year 2022, though, the estimate is $3.20. So that is lower than the $3.35. And then we look at the trend, and that is coming in lower as well, although almost barely, I guess, minus 1%, minus 0.6%. But the trend is insinuating that they might fall short of these forecasts. All right, so that's EPS. Let's take a look at revenue. So average sales estimate of $168 billion. That would be minus almost 2% for the current year over the year before. Looking ahead to 2022, $158 billion. That would be minus 5.9% over fiscal year 2021. So in the case of AT&T, while we do have a handful of analysts who have a strong buy currently, I gotta say, even though the valuation has some positives, negative EPS growth and negative revenue growth has me thinking that perhaps AT&T is not out of the dead money club yet. Certainly for my standards, without that kind of positive revenue growth, it's not going to be a stock that I would invest in. All right, guys, so those are 3 dead money stocks, at least from the opinion of some writers, including myself. Let me know what you think of each one in the comments and if you see it bouncing back at all. As always, please give the video a like, share with your friends, subscribe to the channel. We'll see you on the next video.